Hey everyone, welcome back to the channel. In today's video, we're going to discuss something that is really trending in the trading industry right now, and it's fair value gap, the famous ICT fair value gap. And as a trader that has been in the market since I think 2017, 2018, I've seen a lot of strategies come and go. I've traded a lot of them, but none of them has given me the holy grail of profitability like the fair value gap. However, in the first few months, I also had bad experiences and negative experiences trading ICT concepts and the fair value gap specifically. So in today's video, I'm going to discuss the good and the bad of the fair value gap and how you can use it in your trading, whether it's CFDs, crypto, or binary options even. So let's get to it. All right, let's begin by introducing what a fair value gap is. Let me turn off these indicators for right now. So a fair value gap is actually an imbalance, okay? You might have heard about imbalances before, and you might know them and be able to identify them. But for those of you who don't, imbalances are created when the price moves quickly in one direction, and many orders get left behind, not limit orders, of course, but some people that want to execute market orders. In ICT's words, a fair value gap is somewhere that institutions are interested in and that the price is likely to return to and revisit before continuing its initial trend. Okay, so the fair value gap is a really easy pattern. It's essentially a 3-candle pattern, and let's see what it is up close. So a fair value gap forms in a candle when it's first in a large rapid move, and the large rapid move should be relative, not absolute. I mean, this move might not be anything in your eyes because it's a 5-minute time frame, but relative to the previous price action, which the price was moving range bound, it's right here that it really began to rally and show an impulsive move. Okay, and the fair value gap is on the body of a middle candle that is not covered by the wicks or the bodies of the next or its previous candles. Okay, so right here, the area of the body of this candle that I'm showing you that is not covered by the next candle's body or its wick or the previous ones will be our fair value gap. In ICT trading, you can use fair value gaps as both entries and exit points, of course. And here you can see that the price has initially created this imbalance or fair value gap, ran a little bit higher, then it corrected, and right on this candle, as you can see, it has dropped again inside our fair value gap. Normally in ICT strategies and when trading fair value gaps, this is a good entry point, and we'll set our entry here. Your stop loss could be below the fair value gap candle, but this is one of the points that I've learned the hard way. You should give the price a room to breathe, okay? If you're really aggressive in your trading, you can put your stop loss below the first candle of our 3-candle pattern, the fair value gap, the first candle's low or above the first candle's high, or the safer or more conservative way is to put it below recent lows, okay? This low, this low, this low, or even this little swing low. There's a small swing low here, okay? But I would place it here just for the sake of the video. And then our exit will really depend on the exit strategies you use. Some people use support and resistance, some people use liquidity hunts, and others might just go with the trend until it takes them out. For example, use a moving average to do so. This is the gist of today's video. That's what a fair value gap is, and it can also be bearish. For example, this is a bullish fair value gap, and here is a bearish one, which again the price has beautifully reacted to. We also have this one, of course. These are 2 fair value gaps that the price has returned to and then got rejected from and continued lower. Okay, this will be another trade with a really good risk-reward ratio. So now that you know what a fair value gap is, I want to show you my personal strategy trading CFDs, specifically Forex, with a fair value gap. Alright, let's set up the ground rules. First of all, I only trade during the London and New York sessions, and specifically during the kill zones. Okay, so if you're not aware of ICT kill zones, I suggest you study them. It's really an easy concept. It's in fact a period of time, and in New York time zone, It's between 2 a.m. to 5 a.m. for London and for Forex trading, of course, and 7 a.m. to 10 a.m. New York time for the New York session, okay? You can also trade the afternoon session from 1 p.m. to 3 p.m., but I really don't like that, so we stick to these two time frames. And of course, I also trade during the whole London session and up until 12. I don't strictly bound myself to those kill zones, but really the best results will come from the kill zones, okay? So here is our day, and this is how we began the day. Here we have a gap, all right? And here we have sell side liquidity. What is sell side liquidity? It's where the buyers, the previous buyers, have put their stop losses below, because all of us, all traders, are taught to put their stop losses above or below recent highs and lows, okay? So there will be a lot of liquidity that the institutional traders will look to exploit, okay, to get their entries. So here is where the prices likely go when we begin the day, and it does that pretty well. It actually sweeps all the liquidity below all these lows, and then it starts to rally. We break a recent high here and also here, but I will keep the first one because it's, of course, a more prominent high. And after that, I will look for two things. First, is our move an impulsive one? And if you look at the recent price action and then look at these consecutive bullish candles, yes, it is. And number two, is there any fair value gap in the move? As you can see, we have 3 fair value gaps right here, okay? So let me show you what I mean. One fair value gap is right here. Another one is right here. And we also have another one. Okay, so the price could pull back to either of these fair value gaps before continuing higher, and that's where we're gonna enter. I personally like to enter on the first fair value gap because I really hate to be left out of the market when I know a move is gonna happen. So I would put my entry point right on the fair value gap, on the higher boundary of the first fair value gap, and I will put my stop loss below the recent low. So how and where do we exit? If you look at this chart, right here we've got a lot of liquidity resting. It's from 2 days ago and it's a daily high. So if you're gonna trade for really aggressive and big RR ratios, this will be a good bet. It's actually a 3-to-1 risk reward ratio. But if you want to take it more conservatively, you can go for fixed RR trades, for example 1-to-1s if you want a really high win rate, or 1-to-2s. But I prefer to go with the price action, okay? So my exit will be when the market shifts bearish. And what is a bearish market shift? When it creates a new lower low and shows that it's gonna continue doing like that, which is right here. So after this candle, I will exit my trade for approximately 2.9 risk reward ratio, and this will be it. So my strategy is really simple. You can put it in a checklist, and yeah, that's it. And about binary options. Now consider you're a binary options trader and you're gonna execute the same trade. So what will you do? My personal suggestion is that you should analyze the charts on a lower time frame, like the 5-minute right now, and target expirations and binary options trades for at least 4 or 5 times longer, okay? So when I'm analyzing the 5-minute, my minimum expiry would be 20 minutes, okay? So if I'm gonna execute a 20-minute binary options trade right here, I will once again enter, but when this candle closes inside the fair value gap, this will be my entry. In binary options trades, we don't have risk reward ratios that are, dynamic. It's fixed and it's always below 1 depending on the payout ratio. So we will be in this trade for 20 minutes, okay? Which is 4 candles later in a 5-minute time frame. So this is 1, 2, 3, and 4. Our trade expires here, and as you can see, it's in profit. Now, sometimes the price acts like this. In these occasions, you can use a martingale sort of strategy that you will risk, for example, $10 on this fair value gap, $20 on this, and $30 on this, okay? If the move is really prominent like this, and if you have a clear picture of the price action that day, and this last one is highly likely to work as an entry if these two don't, okay? So this is the risk you should take. Of course, not everyone is comfortable with that, but binary options are risky and you should consider this. So yeah, this is my binary option strategy using fair value gaps. It's a really simple one, but I can guarantee you with my experience over the last few years, it's one of the best strategies you can have because it's simple and it can be profitable if you know how to interpret the chart and have the tape reading experience that many of us traders who have been in the market for over 5 years have. All right. So yeah, that's it. And don't forget to subscribe to the channel and hit the notification bell so you won't miss any content that we publish. This month is going to be a huge one and we're going to put out a ton of educational stuff for fellow traders. So see you in the next one.